Hey everyone, it's Alloy, and the time has come once again to discuss liquidity in the market and how it can change your life and mine, but I'm going to donate my time to talk about this like I used to. So, right in here, obviously, for folks who are used to digits, we have the dark pool graph up, right? This is a classic friend, but it has not served us as wealthily because the market's been pretty tepid. It's been pushing a lot of people out. There's even stories of people getting margin called, which is a totally different topic about responsibility and risk management. But suffice to say, it's not easy after it's been so breezy, right? And where I'm talking about COVID right now, I'm talking about how in March 2020, if you bought that dip, you're doing really good right now. All right. And that was the beta of digits. So actually, just a little bit before that, we started digits around December 2019. Is when the beta really launched for digits with a small community prior to that. And it just so happened that upon launching digits into what was a pretty boring bull market preceding, a Trump presidency, big things were changing, and then COVID happened, right? So that's sort of the story about how we came to be in the first place. And I'm here to tell you that those times are here again. That liquidity, we're responsible for creating that for so many people, is popping up once again. So if you were around in the beginning, you know exactly what that means. If you were not, then to be very clear, the market is going to be a lot less volatile carrying forward. And the direction we're going is up, right? So I'm going to explain why I believe that that's true. And I'm going to explain also briefly that that does not mean it's going to be easy. This is not, the history is not a guarantee of future results. I know it's a plateau. I was just trying to think of a more concise way to put it than that. And what's important to realize is we're not going to get another COVID. It's not just going to be so easy, but we are going to see liquidity enter into the market in such a way that most days, whatever you're holding will probably be up. Okay, so it's going to be a lot more so about your entry positions than it is about your timing. Like, it's really just going to be about the valuation that you touch up on and writing it up. You don't want to miss out on anything. You don't want to buy in when greed is really high. Still, like I said, it's not going to be just those. I mean, remember, the SPY would go up like 5% a day back. That's not going to happen again, just like that. I'm warning you about that. That's the sober warning. The fun, not dad, but maybe the cool uncle warning is if you don't have your money ready to go, you're going to miss out. You want to take some risks. Not everyone is going to be perfect during this. You're going to lose some, win some. I'm pretty confident you're going to win more than you lose. Meaning I personally am going to be playing a much more active role in the market than I had been previously because, well, now it's time to talk about the volatility we've been experiencing. That's actually a good segue. So because of a lack of liquidity, or rather a bouncing effect of liquidity, it tends to enter and leave, and that's more or less a result of modern events, namely the war, resources, commodities, even crypto. I mean, let's not forget how crazy NFTs, SHIB, all this junk has been really, and then GameStop never really ceased, AMC. Now it's probably at a more appropriate price, but I would still say the volume is ridiculous on it. So all these things are still mingling, and that volatility has been represented on these graphs and with the dark pool's participation in terms of like what liquidity they're willing to provide. That being said, that's really the difference here, right? Is when we have that liquidity, we reduce that volatility and lines go up, okay? In the apish terms, lines go up. We're going to want to pay attention to a couple things here that also distinguish. I keep saying it's different than COVID. How is it different than COVID? Really, where is that information? That information, I think, is really interestingly represented by treasury yields, actually. We have a lot of people buying treasury bonds, and that's always the preferred portfolio decision. I mean, just generally your asset management, that's usually a better call to make than betting into a market that's really volatile, right? Just generally speaking. And so a lot of things have been sort of, again, mingling to make that work for people. So we have the trend here that treasury yields are going up. A part of that is because of the Federal Reserve's response and more or less duty to create a safe investment haven somewhere, or at least to mitigate risk in the existing havens. So what this is partly a response to is the volatility. You can see here specifically this month, it's been quite a response to the volatility. This month has been particularly interesting. People are looking for different places to put their money, but it's not just that. We know that Biden's got the revitalization electric vehicle. Really, no one knows what's going to get passed finally. But we've even got things like a federal marijuana bill. Lots of stuff is going on. And so people are interested in treasury bonds. Now, the reason why this is different than COVID is because back then, my goodness, people could not get out of government bonds quick enough. The yields weren't particularly good, and they couldn't offer higher yields. That was coming in the future. Once COVID was over, the government was going to do this anyway. It wouldn't have mattered who was president, Biden, whoever. They would have announced some plan to revitalize everything because we had bad infrastructure, bad bridges, bad roads, everything, and it needed to happen. And sort of COVID was this accelerationist effect that took a hold of the country, right? So these bond yields, I don't think necessarily are going to go down. I'm not super keen on any theory that suggests they're going to go up. It's just not the world we live in, such that where people's money will be long term is in really rewarding interest-bearing bonds. That's just not really where it's, again, more of a safe haven. You can think of it as like how gold used to be considered. You're investing in the government and it's promised to return something. So, as we know, our culture and our modern economy is shaped much more by privatization. And even at that rate, when it comes to government contracts, the reliance and the liability being handed over to the private sector. So these are the yields. I don't think they're going to get much higher. I do think that they're going to remain rewarding because I think that we have a lot of infrastructure spending that's incoming, right? And we are going to see returns from some effort to, get our shit together, to be completely frank. So we're going to fix some bridges. Some investors who invest in those bonds are going to be happy about that. But this is not a bearish thing for the market, is what I'm saying. Okay, so I represented the volatility here in this graph for everyone, but what we can also see is that these levels are as high as they were during COVID. Now, I actually saw this after I saw a tweet that I presented to the chat. So why don't we go ahead and look at that real quick. Believe it or not, this is the same data as the dark pool graph combined with this information here. I accidentally erased the dates making this video, but this is basically now until the end of April. Okay, so the puts that we have is pinning SPY at a certain price below. The risk is gone, okay? Because if we drop, the market makers or institutional investors will collect those shares no problem. It's not a loss for them to collect those shares at a lower price. And in fact, they don't mind selling puts at that price because beyond that, they don't think it will happen, right? So this put call ratio being this really magnified, if you will, 2.3 rounding down, is really stable. The liquidity is going toward making sure the market is safe where we are and probably has the energy and wherewithal to go up. Wherewithal, energy, these are very general concepts. I'm talking about liquidity. I'm talking about sort of the interdependent effect or the feedback loop that gets created by options buying, options power. You're buying insurance against the market going down. That is always how they should be thought of. Of course, you flip them for premium. That's totally fine. But what you're flipping is an insurance policy, right? With an expiration. That's what you need to understand. So when people are buying this crazy amount of puts, we're pretty fucking insured, aren't we? Okay, now that's not always the case, but when you're looking at a 1 month timeline in combination with all this other data, it's really a macroscopic understanding rather than this detail-oriented, nuanced one where you could go wrong somewhere or suddenly, the next chunk of data could prove all of your assumptions false. No, that is not what we're looking at here. We are looking at a stable, systemic interaction from institutional investors, which holds a lot of promise for stabilizing the market and allowing us to trend upward again, without it being about volatility, without it meaning that we're headed anywhere that people cannot, account for the risk of. Okay, so it's very hard to form some of these sentences, but let's go ahead and look back at that image now. So we see, again, those put calls are represented by the net long and net short axis here. Essentially, we have that dotted line, and above that is when the position has been, or the money has been much more toward a long position. All right, and net short is obviously, you know, if you're selling calls and you're raking in that premium, that is a net short position, right? It's not about buying puts. Buying puts is an insurance policy. Selling calls is selling that insurance policy to someone else who believes that the volatility, or for whatever reason, lack of liquidity means we're going to go up, which would have been ridiculous. But there are always, you know, there's a fool born every second or something like that, they say. So there's always buyers for call premium. And that's what they've been doing with net short positions for a really long time, is pinning the market at certain, you know, strikes and writing and selling those calls and making sure it doesn't hit that, but that we also don't go down. That's been this weird tug and pull that we've been experiencing the last couple of months. And I know if you've been trading, you relate to that, especially in March. And that's why we've seen the market dip. And sometimes, like, really dramatically, we've had a couple of drops where people panicked and stuff, and yet it just kind of floated right back up, and it never became a big deal like we see in some of these other, you know, 2020 March, COVID hit, all these other circumstances. I think some of this other stuff is riots, but what's really important to know is that the money has decided that these are good valuations given recent events, even, I mean, in spite of it all. And I'm going to share my opinion on those geopolitical situations that I'm sort of beating around the bush on. Look, the war in Ukraine is a really complicated thing. It's not something that's just, it's not something that popped up out of nowhere, okay? It's not something that we couldn't have done anything about. It's something that's been in the works on the geopolitical sphere for some time. So for some of us before we were born. And so that's really important to know, that the risk is understood by, goodness, forgive me for using this term, but elites and likewise market makers for a while, that this risk is not so fear driven for them. It's more about understanding what this is going to do to the markets given what they know. They understand that Ukraine, you know, exports 45 or something % of the wheat that the world consumes. They know that Ukraine has some of the most talented coders. They know that Ukraine has a better education than Russia, and that this will affect a lot of people. I mean, and that's just Ukraine. I don't know enough, but I know that Europe is, I mean, Germany and the energy crisis, you could go so many directions with this, but it's important to note that other people have gone those directions with these topics, that these aren't, they're more baked in than maybe some people would have you believe. Okay. And I think that is important here, because when you look back on this, or if you're going to decide to believe this data and heed my analysis and think that this is a time to buy, you're going to go with my flow here, then you need to believe that Ukraine isn't a problem, that the war is probably not a problem for the market. And in order to believe that, I have to convince you that other people don't think so. Because it's not about, you know, my money and my liquidity in the market. It's about the larger financial zeitgeist that drives the market, right? And I'm saying to you as convincingly as possible, I don't think those people are scared of the war. I don't think they're worried so much about commodities. I think that they understand that things are going to keep floating on. In some ways, looking at how this has affected other countries versus the United States, we've shown pretty remarkable resilience to say, you know, again, in spite of it all, it's really easy to remember where we went wrong and what was on the news. But in some ways, you know, we've held it together. And I think that that's a really big, even lagging indicator, though, of where the market belongs and where other institutional investors believe that the market belongs. And they're speaking with their money. It really just comes back to this graph. I'm convincing you that these things are true in a very realistic, tangible sense. But what we also have here that needs to be acknowledged, that the data is saying they're pouring money in again. Okay. Last thing I'll say about this, and I hope this really rounds out the whole video and explains why this was an important one to make. These things don't happen super often. You can't say they're rare. I mean, looking at this graph, you get a couple chances, you know, every decade or so. It looks like you could round it out about that way. It looks like about 7 chances. And there's actually really fancy math algorithms like Poisson distribution that can predict how often these things happen given, you know, a time window of 10 years if you have previous data. the statistics, the chances of it happening 4, 5, 6 times relative to the past window of time you gave it. There are ways we can find out how often this happens in a decade. But just looking at this graph, we can see that this happens maybe, as much as this is interesting to our attention span, 2 or 3 times maybe in 5 years. That's pretty greedy way to look at it. It makes the market sound fun and like there's waves to ride, right? This is a wave. That's what I'm telling you. This is one of those things that happens in a goldfish time frame in a pretty slow manner every 5 years. All right, you do have to wait. But if you're not as if you're thinking about a longer term strategy, then this would be one of those things that you're just constantly looking forward to in every 1 decade span of time. You're just looking out for these moments. And so whichever side of that coin you're on, if you're someone who's like really looking to get in and you've been tired of the way the market's been working and you're frustrated, I have great news for you. I think this is what you've been looking for. All right, just be careful. And if I'm talking to you, then you are a newer investor probably if you're thinking shorter time frames, because you're more eager and you're more excitable, and that's all normal. But I'm just saying this is probably what you're looking for, and still, do your work, do your due diligence. Handle your risk management. No, nothing comes for free. It's still gonna come with challenges, but it's looking like a really good environment to invest again. Okay, now for those who are more longer term thinkers, you probably don't need to hear too much of what I've got to say about this. You're probably convinced because of, like I said, you've been waiting for this for quite a while and you're excited, and you haven't been impatient. You're just kind of slowly waiting, and you know that you'll catch it. Well. Then simple. Now's the time. We waited. We were patient. We're going to be rewarded for it. No grandiose thing. It's just how the market works. You wait, you time it, you look for that data, you educate yourself. And while everyone else is freaking out and they're a little uncertain, you just remember why you did what you did. I'm investing now because asset prices are lower, and yet the valuation is being, we're seeing a lot of liquidity here at these valuations, as we know. The only effect that has is it drives prices up, creates more supply and demand. Companies do better. Shares are liquidated. Splits happen. All these things occur, and the market is, generally speaking, bullish, healthy, green, whatever word you want to use. But that's what we're looking forward to here. So, meta context for this video. Right before I end it, reason I made it is because I think that it's really easy to say, hey, market's going up, put your money in. And we hear that a lot, though. So why is now different? So these reasons are why now is different. That's why I'm saying it. And you might see that a month ago from someone on Twitter and they were wrong. I'm not them. All right. I didn't say any of this a month ago or a couple months ago. I was very cautious this whole time. I've been waiting. And so my wait's over. I'm sharing that with you. I hope your wait's over now. And I say, don't put all your savings into it. Again, manage your risk, but really exciting times ahead. And be nice to people. It's still tough. We do still have a war going on, and we do still have a lot of people struggling. We still do have supply chain issues. And the market's totally separate from that. So just keep your head on right. Put your money in. Work with us. Talk to us in digits like we always do. You stick around the community, and I don't think anyone here will go wrong. And might pay off some student loans or buy yourself a house at the end of this. We'll see. All right. Thanks, guys. Enjoy your Friday, and thanks for listening. Oh, like and subscribe, I guess, huh?